Welcome to this explainer. If you've ever stared at a company's financial statements and felt like, hey, I'm only getting half the story here, you are in the exact right place. Today, we're diving deep into analyzing balance sheets, but we're going way past the usual suspects. The factories, the inventory, the cash. We're going to uncover the complex, kind of invisible stuff hiding right there on the balance sheet. I'm talking intangible assets, goodwill, tricky financial instruments, and non-current liabilities. Plus, we'll look at how to actually make sense of all this complexity using common-size balance sheets and equip you with those absolute must-have ratios to stress test a company's liquidity and solvency. Let's get into it.
Here's our roadmap for today. 1. The value of invisible assets. 2. Decoding goodwill in acquisitions. 3. Complexities of financial instruments. 4. Navigating non-current liabilities. And 5. Common-size balance sheet analysis.
Section 1. The value of invisible assets. Recognizing what you can't touch.
So let's explore how the accounting world handles incredibly valuable assets that literally have no physical substance. When we talk about intangible assets, we're looking at identifiable non-monetary assets that you simply can't touch. Think patents, licenses, copyrights, trademarks, stuff like that. But here's the catch for getting them on the books. To be recognized on the balance sheet, an identifiable intangible asset has to either be capable of being separated from the company, meaning you could literally sell it off on its own, or it has to come from specific contractual or legal rights. And as an analyst, you always have to ask, is its useful life finite or indefinite? A finite asset gets amortized over time, kind of like a patent with an expiration date. But an indefinite asset, like a strong, renewable trademark, that's not amortized. Instead, it's tested every single year to see if its value has dropped, which is called impairment.
Now, this is fascinating because it brilliantly illustrates how the rules completely change depending on where you are in the world. Specifically, this happens when a company creates an intangible asset internally, rather than just going out and buying one. Figuring out the cost of internally created intangibles is notoriously tricky and super subjective. While both IFRS and US GAAP generally make you expense research costs right away, IFRS actually throws a bit of a curveball. They allow you to capitalize internal development costs, meaning you get to put them right on the balance sheet as an asset, if you hit very specific criteria, like proving technological feasibility. US GAAP, on the other hand, they take a much stricter approach, generally forcing companies to expense both research and development exactly as they happen.
Section 2. Decoding goodwill and acquisitions. The premium for synergy and reputation. Okay, so what happens when one company buys another but pays way more than the fair value of its net identifiable assets? Where does all that extra premium go? Well, that premium is recorded as goodwill. But we really have to draw a hard line here between accounting goodwill and economic goodwill. The absolute crucial point to remember is that accounting goodwill is strictly a byproduct of an acquisition. It just sits there on the balance sheet, it isn't amortized, and it has to be tested for impairment every year. Economic goodwill, however, is a whole different beast. It's based on the actual economic performance of the business. It's the true value of things like a stellar reputation or a highly trained workforce that investors are actively pricing into the company's stock, even if it's never explicitly listed on the balance sheet because, well, no acquisition actually took place.
Let's look at some real-world examples. Take a look at these financial exhibits from SAP and Apple from back in 2017. They perfectly highlight how goodwill completely reshapes asset composition across totally different strategies within the exact same tech sector. You see, SAP has historically been highly acquisitive, buying up a lot of companies, while Apple is usually leaned toward growing organically.
And because of those different strategies, check out this number. Goodwill makes up 50.1% of SAP's total assets. That's half their balance sheet. Compare that to just 1.5% for Apple. This is a massive, massive structural difference. As an analyst, if you're trying to compare these two giants or calculate something like return on assets, you often have to strip out that goodwill entirely just to evaluate their true operating trends cleanly and on a level playing field.
Section 3. Complexities of financial instruments. Valuing paper assets and contracts.
As we dive into slightly more complex territory, we need to decode financial instruments. Once a company acquires a financial asset, say another company's stock or some bonds, it doesn't just sit statically on the books gathering dust. After initial recognition, financial assets are subsequently measured in one of three buckets: amortized cost, fair value through other comprehensive income, or fair value through profit or loss. And which bucket an asset lands in depends heavily on the company's underlying business model. Like, are they just holding it to collect interest, or are they planning to sell it for a quick profit? It also depends on the instrument's specific cash flow characteristics.
This exhibit right here gives you an amazing mental grid to see exactly how both IFRS and US GAAP categorize these tricky instruments. For example, if a debt security is held purely to collect principal and interest, it's measured at amortized cost. Easy enough. But if it's classified as a trading security under US GAAP or measured at fair value through profit and loss under IFRS, any unrealized gains or losses, meaning the price fluctuated but you haven't even sold the thing yet, hit the income statement directly. That creates some serious volatility in net income. Now, if it's in that middle bucket, fair value through other comprehensive income, those unrealized changes bypass the income statement entirely and go straight to shareholders' equity.
Section 4. Navigating non-current liabilities, long-term obligations, and promises.
All right, shifting our focus over to the right side of the balance sheet. While traditional long-term financial liabilities like floating and fixed-rate bonds are relatively straightforward borrowings, analyzing other non-current items definitely takes a bit more digging. Take non-current unearned revenue, for example, which you'll actually see on both SAP and Apple's balance sheets. This represents cash a company collected up front for goods or services that it is obligated to deliver way out into the future, well beyond the next 12 months. So yes, it's technically a liability right now, but it's essentially locked-in future revenue.
And as this excerpt regarding lease disclosures reminds us, the ultimate goal of parsing through all these long-term liabilities isn't just to do a boring accounting exercise. It is absolutely crucial for accurately assessing the amount, the timing, and the uncertainty of a company's future cash outflows. Whether we're looking at massive bonds, deferred tax liabilities, or super complex long-term leases, at the end of the day, we are just trying to model out exactly when the cash is actually going to leave the building.
Section 5. Common Size Balance Sheet Analysis, Standardizing the Complex. So how do we evaluate things like liquidity or solvency across the board? If raw dollar figures obscure the underlying structural reality of a business, what kind of analytical glasses do we need to put on to really see the big picture? I mean, how can you meaningfully compare a highly leveraged $9.75 million enterprise to a scrappy, nimble $3 million startup? The answer is common size analysis. This is literally our ultimate decoder ring. Vertical analysis divides every single balance sheet item by total assets, expressing them as a pure percentage. This magically strips away the noise of company size, so we can analyze the exact percentage mix of how a business invests and finances itself. Meanwhile, horizontal common size analysis takes an item and indexes it relative to a base year, which lets us easily spot structural trends evolving over time.
Let's actually look at this in practice. Staring at the raw dollar balance sheets for these three hypothetical companies, notice Company C. Its massive $9.75 million asset base completely overshadows companies A and B. Just glancing at these raw numbers makes any direct structural comparison virtually impossible. The sheer scale completely distorts the financing choices that are being made.
But watch what happens when we apply vertical common size analysis here. We convert everything to a percentage of total assets, and boom, a massive insight jumps right off the page. We can clearly see that Company C relies heavily on long-term debt to fund its property and equipment. If we were to calculate solvency ratios here, like debt to equity or financial leverage, Company C's metrics would look dangerously high compared to Company A, which is almost entirely equity funded. Similarly, if we ran liquidity checks using current, quick, or cash ratios, this vertical analysis instantly tells us exactly where to look for hidden cash flow bottlenecks. It's a total game changer.
So now that you know how to decode invisible assets, map out those tricky financial instruments, and deploy common size analysis alongside vital liquidity and solvency ratios, the ball is firmly in your court. Will you use these metrics to spot a hidden solvency crisis before anyone else does? Or maybe uncover an equity-rich opportunity the rest of the market completely missed? The true financial story is always waiting just beneath the surface.